We see three major trends affecting pension funds today. The first is the investment environment surrounding pension funds. The second is the regulatory environment. And the third challenge is what we call the maturing of many of the pension funds. When we think about the investment environment surrounding pension funds today, we're all pretty familiar with the equity performance over the last decade with its flat performance. Now that's been paired against a liability that grows year in, year out at its discount rate. So that's caused a huge gap in the funded status of the plan. One thing we fail to recognize or not as familiar with is just how well bonds have done over that last decade, where yields have come down significantly and generated this 3-decade-long bull market in bond prices. Now, as we think about the investment environment going forward, starting with the bond side, we know that the yield is a very strong predictor of future bond performance. So the low yields today spell lower returns for bonds in the future. So overall, on the investment side, we see low yields and lower returns than historical. On the regulatory side, what we've seen across all the different types of pension funds is that the regulators have tightened the funding requirements that surround them. You had for single and multi-employer pension plans, you've had the Pension Protection Act. And on our public retirement systems, we've seen the new accounting standards that are coming out. And then finally, when we look at what we call the maturing of pension funds, is that the portion of the liability that's associated with retirees and beneficiaries versus actives has grown over the last 20 years. And the implications of that is that the need to raise cash to meet benefit payments every month is larger than ever. And certainly that influences your investment allocation. What funds need to do to respond to these challenges today is to think more broadly about managing the risk of the pension fund. They need to go beyond just focusing on one aspect of the liability, that discount rate, and think about aspects such as the funded status of the plan or the maturity profile. We here at Segal Rogerscasey have identified 3 strategies to meet these challenges. The first approach we have is what we call dynamic asset allocation. Traditionally, pension funds establish one target asset allocation for the pension fund and then rebalance back to that target allocation. What dynamic asset allocation does is it changes the strategic weights of the portfolio as the needs of the pension fund changes. A focus here is on the funded ratio of the pension fund, and using that to change your allocation over time. And what that ends up doing is reduce downside tail risk that these pension funds face. The second approach we have is what we call liability hedging strategies. And those are asset classes that have characteristics that manage the risk that comes from the liability side of the balance sheet. Examples of this could be inflation or interest rate risk. And then finally, we have what we call liquidity strategies. This recognizes that some asset classes have more attractive risk-reward relationships, but they also have less liquidity. It's more important than ever, with pension funds needing to meet their benefit payments monthly, that you understand the capacity of the pension fund to invest in these asset classes. These are the 3 strategies and approaches we have to respond to the environment today. Thinking about the challenges facing pension funds today, the investment environment, the regulatory environment, the demographics, pension funds need to utilize every tool available to manage risk and to maintain their healthy funded status.